Hey guys, this is Rudy for Best Investor. We have to welcome in February because today is February the 1st. And what we are going to do is take a quick look at the GameStop winners and losers from the big GameStop Game of Thrones that just started playing out in a big way last week, and will probably reach somewhat of a climax this week. We'll have to kind of wait and see what happens. But before we get into that, I just wanted to quickly share something with you, which is really cool because for all my Oxy fans today, some really good news about Occidental. Occidental Low Carbon Ventures, together with Macquarie, delivered the world's first shipment of carbon neutral oil. Houston, January the 28th, that's last Thursday, Occidental Low Carbon Ventures, a division of Occidental, announced that it had delivered 2 million barrels of carbon neutral oil to Reliance Industries in India. The transaction, which was arranged in conjunction with Macquarie Group Commodities and Global Markets Group, is the energy industry's first major petroleum shipment for which greenhouse gas emissions associated with the entire crude life cycle, wellhead through combustion to end products, have been offset. The transaction is the first step in the creation of a new market for climate differentiated crude oil. It is also a bridge to the development of further differentiated petroleum product, net zero oil, which Occidental intends to eventually produce through the capture and sequestration of atmospheric carbon dioxide or CO2 via industrial scale direct air capture facilities and geological sequestration. Really cool news by Occidental Low Carbon Ventures. But anyway, this video is not about Occidental Petroleum. There's always something about Occidental Petroleum. Neither is it really about Occidental Low Carbon Ventures. It is about GameStop. So I'll see you on the other side.
This is what you came for. This is what you came for. I'm over. This is what you came for. I'm over. This is weird. She said, I'm ready. So come and get me. I'm over here. I'm over here.
So guys, let's take a look at GameStop. Power to the players. That's their slogan. Who really made money last week and maybe even still this week? That's what we're going to talk about. The first thing I wanted to sort of point out to you, and this is just a snapshot from GameStop earlier today. You will notice on my slide over here that the total number of shares outstanding is about 70 million, 69.7 million. So we'll just round it up to 70 million. And here's the thing that is so odd about GameStop, right? You can see right now that, well, as of today anyway, held by institutions, 112%, which is about 78 million shares. So if there are only 70 million shares outstanding and almost 80 million of them are held by institutions, we have somewhat of an anomaly. And that anomaly is somewhat explained by the fact that the short interest is 122% as of today, which is about 85 million shares. So there's still a delta between the institutional shareholders and the short interest, and that delta can best be explained away by shareholder interest, for instance, by insiders who work at the company, including the CEO, but more about that later. But this is a very strange or unique anomaly. By the way, you can notice right at the top of the screen here, at the time I took the screenshot, GameStop was trading at about $230, which is down almost $100 from where it closed on Friday. This is a more normal picture. Now, normal obviously means different things to different people, so we can all be relative in that regard. But this is Occidental from a little earlier today. Total number of shares outstanding about 930 million. Approximately 65% of that is held by institutions, so that would be about 600 million shares of the total share pool that's outstanding, and approximately 3.4% of it is short, which is about 30 million. This is a much more normal picture in terms of looking at any particular equity without getting these incredible short squeeze scenarios that perhaps come into play. Let's look at GameStop insider transactions, and this is quite an interesting picture because you could see, firstly, There's not a lot going on at the beginning of last year, so this is 2020. And then you can see there's a little bit of selling going on sort of as we go into mid-year. And then you get a huge uptick here, which is a purchase. And then we go into July. You can see a little bit more negative trending. Then nothing happens for that particular quarter, for most of the quarter. And then you see some downward pressure happening as we go from 2020 into 2021. People are actually selling. That's the light blue line on this particular slide over here. Let's look at what it means. So insider confidence is generally negative because we've seen more sales than what we have seen buys from the insiders. Negative sentiment based on 6 informative insider transactions by 5 unique insiders over the last 3 months. Informative insider transactions, by definition, is a discretionary and not related to routine actions such as options, exercise, or payment of stock. The reason why that's important is because you cannot really control when your options vest. The options vest is part of the actual option plan. So if your options were vesting and you wanted to exercise them, do a cashless exercise or a sell to cover or something like that, you can only do the options exercise when they vest, but you cannot control the vesting period. So informative insider transactions means by choice. In other words, this is what they decided to do. An informative buy might be considered bullish, and an informative sell might be considered bearish. Here we had multiple sells by insiders, therefore it's negative, and the informative insider transactions are negative. The top holders, this is very, very interesting because these are the people who really, really made money. And when I say made money, I'm talking about hundreds of millions or billions of dollars compared to the individual investors who might say like, yeah, we're sticking it to Wall Street, we're showing them what we can do. Obviously, the target of the anger is directed at one particular hedge fund, which is Melvin Capital. I'll come back to that one in a minute as well. But look at these names. These are guys who are long holders, long in GameStop, Fidelity, Blackrock, Vanguard, Susquehanna International. And you see some people here. So Donald Foss and George Sherman. I'm going to talk a little bit about those two guys as well, because they are individuals here amongst a sea of institutional investors with deep pockets making an enormous amount of money on GameStop as the shares were squeezed and the stock was trading higher. Who is Donald Foss? Well, he's a billionaire. Forbes suggests that his wealth is about 2.2 billion, and he's the founder and former chairman of the subprime auto lender Credit Acceptance Corp. He launched the company in 1972, and he was the first person to offer loan programs that help dealers sell cars to customers with poor or no credit. He ran Credit Acceptance as CEO for 3 decades before he took it public in 1992. Then he cashed out, and now he's one of the owners in GameStop, who has been making hundreds of millions, if not more. So before we say we were sticking it to Wall Street and we were really putting a squeeze on the billionaires, just keep in mind that some companies like Fidelity and Blackrock and individuals like Donald Foss are coining it based on the increase in price. How about this one? GameStop CEO shares are worth nearly $1 billion. And boy, does he probably want to sell. Who is GameStop CEO? Well, he's this guy over here at the bottom, George Sherman, who owns a couple of million shares of GameStop. This is according to Fortune. What about the mutual funds? The reason why I looked at the mutual funds is because mutual funds, unlike individual investors, generally publish a prospectus which is going to be with them for the next year or so. They don't make buy and sell decisions very easily. When they get into a stock, they tend to hold it long for at least 1 year, maybe even longer. But look at the names on this list here. These are mutual funds run by iShares, Fidelity, etc. Vanguard again. These are not people who get in and out of stock positions very quickly. And when you look at the number of shares that they hold, or held anyway, because it depends on the date. So let's see, the most recent date here would be like December 31st, 817,000 shares by Vanguard, but Vanguard is in the list several times. So it's worth billions, guys. We're not sticking it to Wall Street. Wall Street is making billions of dollars. Melvin Capital, this was the target of the anger. Who had ever heard of Melvin Capital prior to GameStop? Probably nobody, right? Melvin Capital lost 53% in January. So what? hedge funds make money, they lose money. At the end of the day, Melvin Capital will be okay, and you might not if you don't cash out. So if you're sitting on a big fat profit, you better take some. Lost 53% in January, hurt by GameStop and other bets. So in addition to GameStop, Melvin might have been short other things as well. Who knows what? Even maybe AMC. Then it says Melvin's losses are the most visible wound in an extraordinary tussle playing out between professional hedge fund investors. Only 47% left to go, one user posted on Sunday. The amateurs made Melvin their principal enemy and have gleefully seized the upper hand. It's just one hedge fund, guys, and it's a small hedge fund, relatively speaking. Melvin was founded by Gabe Plotkin, a former star portfolio manager from hedge fund titan Stephen A. Cohen, who's, by the way, the guy who bailed him out. It started the year with 12.5 billion and now runs about 8 billion. The current figure includes a $2.75 billion in emergency funds that Citadel, that's Stephen Cohen, its partners, and Mr. Cohen's 70.72 asset management firm injected into the hedge fund on January the 25th last week to help keep it afloat. Anyway, that's Melvin. Guys, if Melvin lost money, Melvin lost money. So what? Big deal. People make money and lose money on the stock market every day. That includes me, and that's why I sometimes say today was one Maserati, up or down. Blackrock may have ranked in $2.4 billion on GameStop's retail-driven stock frenzy. We're sticking it to Wall Street? Nuh-uh, Wall Street's making billions. BlackRock, by the way, talking about sticking it to Wall Street, is one of the largest asset managers in the world with 8.7 almost trillion dollars of assets under management. They could have made gains of about $2.4 billion on their investment in GameStop as retail investors poured money into the video games retailer shares. So guys, I just want you to have some perspective here, because you think that you're hurting Wall Street. No. Wall Street is making money, probably much more than you and me, and much more than you and me and all of us put together. By the way, the other thing that you need to think about is, why is it that these guys from Wall Street Bets are such incredible experts on trading derivatives and reading and interpreting and understanding Bloomberg monitors? It's because they are pros. They have just managed to suck in a few million retail investors who help them to create the squeeze that we are currently talking about. Chewy.com's founder, of course, Ryan Cohen, acquired a 12.9% stake in GameStop last year for $76 million. At Monday's high of $159 a share, his stake in the video game retailer had swelled to $1.4 billion. Well, that was last Monday. So this Monday, it's, let's say at $300, just to make it easy math, Mr. Cohen's stake is worth $2.8 billion, almost $3 billion. So effectively, the billionaires are getting rich as GameStop is being squeezed. So don't think for a minute that us guys, the small investors, the retail investors, are really putting a squeeze onto GameStop and the hedge funds and the billionaires. You're not sticking it to the billionaires. The billionaires are making more money than you and me. So did you make money on GME? If you made money on GameStop, I am delighted for you. In fact, I'm really, really happy for you. And I sincerely hope that you've taken some money off the table. Just take a little bit of cash off the table. In fact, even if you just take off the table what you put in, that would be great. And has the party ended? Maybe it has not. Maybe it's still going to continue for quite a while, because you can see based on the first slide I shared with you, the squeeze is still on. If you have not subscribed to my videos yet and you like the content, please hit the subscribe button, because I'd like to include you in my big family my big ever-growing family of like-minded investors who are striving to build generational wealth. So there you have it, guys. That's a wrap. If you did make money on GameStop, AMC, COS, the Naked Brand, any of these short squeeze targets, I am happy for you. I am honestly delighted for you. But I really hope, as I just said, that you take a little bit of cash off the table, because none of these things last forever. And by the way, if Wall Street wants to bite back, they will, and they will hurt you in ways that you don't even know how you can get hurt. So I don't want anyone to lose any money. If you've made some profit, take a little bit off the table, put it somewhere else, put it somewhere safe, whatever that might mean to you. But don't just hang on for dear life. And on that happy note, this is Rudy for Best Investor, or Mr. Oxy if you'd like, signing off saying keep well, stay safe. Talk to you soon. Bye.